Step away until your mind is clear.
Take a break.
Absolutely. Now, here's a tough one. If you genuinely believe, based on your analysis, that a trade will eventually become profitable.
But it's currently losing money.
Exactly. Don't exit manually just because you're scared of the current drawdown, the current paper loss. The sources warn that you'll never make significant money if you constantly cut winners short due to fear.
You have to trust your analysis.
You have to wait for your target if your analysis still holds. It requires patience and conviction.
Okay, but what if it's just too much? Psychologically.
Yeah, they acknowledge that. They offer a psychological safety net. If the situation becomes psychologically unbearable, you just can't stand watching the loss fluctuate. You can move your stop loss to your entry point.
Break even.
Right, moving it to break even. This locks in that you won't lose capital on this particular trade. It frees your mind, even if it means potentially missing a profit later if it turns around. It's a tactical move purely for mental peace.
That break-even move makes total sense as a way to just de-escalate the fear response while preserving capital.
Okay, so we've covered the pull of greed and the paralysis of fear. What's the third big obstacle?
Excitement. And here, the sources issue a pretty blunt warning. If you have a gambling streak, just stay away from trading. It will stop.
How does gambling relate specifically to trading excitement here? What's the connection?
Well, the sources explain that gamblers, or people with that tendency, they lack the courage to miss an opportunity. They see any market movement as a potential play, something they have to be in on.
Fear of missing out? FOMO. Exactly, extreme FOMO. This leads them to enter trades against the prevailing trend very easily, kind of hoping to catch a reversal.
Which usually doesn't end well.
Typically results in large losses and maybe minimal gains if they get lucky. It creates a state they describe as madness mixed with a little hope, where they lose control, start chasing losses, and inevitably deplete their capital.
It sounds like the thrill of placing the bet, the action itself, overrides any kind of logical approach.
That's precisely it.
Mm-hmm.
And the source materials stress that successful trading demands the complete opposite of this gambling mentality. It requires calmness, dry logic, discipline, and meticulous planning. No room for just chasing excitement.
Right. So bringing all these emotional hurdles together, the greed, the fear, the excitement, what other key insights and practical takeaways do the sources want us to grasp about the reality of trading? Any other major points?
Well, yeah, they address some common misunderstandings head on. For instance, some people just dismiss Forex as a scam, saying there's no real profitability.
Heard that before.
Right. The sources attribute this view mostly to a lack of information or maybe just bad initial experiences. Others, they say, look for a golden cup, some magic indicator or secret system that guarantees profits.
The holy grail of trading.
Exactly. And the sources are very clear that the golden cup, the holy grail, it isn't magic.
So what is it then?
It's presented simply as your work and your practice. They compare a successful trader to a professional athlete who needs constant training, constant practice to perform consistently well.
It's a skill to be honed.
Absolutely. Trading isn't, as many beginners feel, an easy game for big profits. That feeling, the sources say, is fundamentally destructive. Trading is a demanding profession. It's filled with anxiety, requires deep knowledge, expertise, sophisticated analysis skills, and genuine courage in decision-making.
So it really emphasizes the professionalism needed. You need to find goals, specific trading times, maybe finding a reliable professional partner like a good broker. Success is for those who can approach it logically, methodically.
Right. And they emphasize that markets are inherently about probabilities. It's always probably, maybe, perhaps. You're dealing with uncertainty.
Can't predict the future perfectly.
No. While you can certainly increase your probability of success through skill and discipline, getting to 100% certainty is, according to the sources, something that requires significant, perhaps even unattainable, effort. The focus should be on increasing your edge, not finding certainty.
Okay. What about order types? They mentioned pending orders.
Yeah, they strongly recommend using pending orders like limit and stop orders whenever possible.
Why is that?
Because placing orders in advance allows you to enter the market at precise price points you determine logically before the heat of the moment, before emotion could cloud your judgment. It helps avoid impulse entries or getting stopped out by minor corrective price moves right after you jump in.
Pre-planning your entries. Makes sense. And if confidence takes a hit.
Good point. If you find your confidence shaken, maybe after a string of losses, they advise scaling back your trade volume. Trade smaller.
Like easing back into it.
Exactly. A smart, practical way to manage fear and rebuild confidence without exposing too much capital. It loops right back to risk management.
And a point they seem to repeat forcefully throughout the material.
Let me guess. Always set stop loss and profit limits.
You got it. Seems non-negotiable for them.
It really is presented that way and connected directly to this. Never move your stop loss further away or your profit limits once your order is active.
Why not? What if the market almost hits your target?
Because moving them is giving in to hope or fear. Your initial limits were based on your objective analysis before the trade got emotional. Fiddling with them breaks your own rules.
So stick to the plan.
Stick to the plan. The only exception they repeatedly mention is moving the stop loss up to your entry point, break even, for psychological relief, or to lock in no loss. That's risk reduction, not adding risk.
Got it. That makes sense. They also stress keeping a trading journal.
Absolutely. Tracking your statistics objectively is presented as key. A journal helps answer crucial questions like, where are the problems in my strategy? How can I improve? How are my results actually changing over time?
Turns feelings into data.
Exactly. It turns abstract results into concrete data you can analyze logically instead of just going by gut feel, which is often wrong.
And optimizing your system. That's ongoing.
Yeah, optimizing your trading system is the foundation. But they caution that no single algorithm or strategy will work forever without regular review and optimization. You can't just design something today that guarantees profit indefinitely.
The market changes.
The market is dynamic. Your system needs to adapt or at least be reviewed.
Okay. And another point that seems maybe overlooked sometimes, rest.
Yes. Highlighted in these sources, rest is crucial for risk management. A tired mind is prone to quick, impulsive decisions, drastically increasing the chance of costly errors.
Makes sense. Fatigue leads to mistakes.
Definitely. They advise resting if you feel tired, or simply taking time off to enjoy the fruits of previous successful trades. Recharge.
Okay, and the sources seem to end with a very stark, powerful warning about the market itself.
Yeah, it's quite sobering. The message is, the market does not forgive your mistakes.
Unlike other areas of life.
Exactly. It's not like a typical job where maybe you can fix a document error or correct a payment later. In the market, every mistake has an immediate, direct cost right out of your pocket.
Instantly punish.
Instantly. A wrong signal, flawed analysis, clicking the wrong button, accidentally selling instead of buying the market hits you immediately and takes your money. No second chances on that trade.
Wow. That unforgiving nature really underscores the gravity of their final big point, doesn't it?
It really does. Which they state very, very clearly. 90% of successful trading depends on emotions and psychology, and only 10% depends on trading skills.
Wow. 90-10. 90% psychology. That statistic alone just hits home, doesn't it? It completely flips the script on what many beginners and maybe even experienced traders prioritize.
It really does. It's a powerful claim.
So looking at all these insights, we've unpacked the common pitfalls, those three big emotional obstacles, the practical, sometimes counterintuitive advice, the absolute emphasis on discipline and self-awareness. What does this all mean for you, the listener, as you navigate your own trading journey?
Well, it seems the message is,
it's clearly less about finding the perfect technical setup on a chart and much, much more about mastering what's happening inside your own head, right?
Yeah, it's about recognizing that the market isn't out to get you specifically. Your own internal state, your reactions, that's often the biggest hurdle you actually face. Host, speaker.
Right.
It's an internal game. Mastery, as these sources seem to describe it, isn't really about conquering the market's volatility. You can't control that, but about conquering your own emotional responses to that volatility.
So as we wrap up this deep dive, the core takeaway from these sources is undeniably clear. Success in Forex, or perhaps trading in general, isn't built primarily on chart patterns or news analysis.
Those matter.
Those matter, yes, but it's fundamentally built on self-mastery and emotional discipline. It's an internal battleground, first and foremost.
Indeed. That's the strong message here.
Okay, so here's a final thought for you to consider, really stemming directly from the perspective of these sources. If the market is truly as unforgiving as they say, and if 90% of trading success really is psychology, does that mean the most critical analysis you should ever undertake isn't of a currency pair or a stock chart, but of your own psychological state before you even think about placing a single trade? Think about the discipline that challenge implies.